Imagine finding perfectly legal ways to keep more of your hard-earned money in your business year after year.
Yeah, ways that are often just sitting there, hidden in plain sight.
Exactly. What if there were powerful financial levers just waiting for you to pull them? Today, we're taking a deep dive into exactly that, the strategic world of cost recovery.
And this isn't just, dry accounting theory.
No, absolutely not. It's really a cornerstone of smart financial management, isn't it? And a direct pathway to significant tax savings.
That's right. This deep dive is kind of your shortcut to understanding precisely how your business assets, everything from the computer on your desk to the actual building you operate from, can legally reduce your tax bill.
We're talking tangible, concrete ways to lower your taxable income.
Right. It's all about unlocking those hidden tax savings.
So we're going to unpack core concepts like depreciation and amortization first.
Yeah, foundations.
And then move on to some incredibly powerful expensing rules, things like Section 179 and bonus
The
depreciation.
real accelerators.
For any business owner, or really any individual with investments looking to truly maximize their financial health, these are absolutely essential concepts to grasp. You just have to know this stuff.
We've pulled together a real treasure trove of insights today, drawing directly from comprehensive tax documentation.
Okay.
So we'll be navigating the Modified Accelerated Cost Recovery System. You'll hear us call it MTRS.
NCRS, got it.
We'll dive deep into Section 179 expensing, shine a light on bonus depreciation, and explore the often overlooked details of amortization.
Our mission then is really to extract the most important nuggets of knowledge from these sources.
Exactly. Make sure you walk away with clear, actionable insights that can actually save you money.
Okay, so where do we even begin with something as, well, as potentially complex but powerful as cost recovery? Let's kick things off with the absolute basics. What is it, fundamentally?
Right.
And maybe more importantly, why does it matter so much for your taxes? The first big piece of this puzzle has to be depreciation.
Depreciation. Yeah, that's the starting point. At its core, depreciation is, think of it as the annual allowance the tax authorities give you for the exhaustion, wear and tear, and normal obsolescence of assets you use in your trade or business.
So the IRS basically acknowledges, hey, your stuff wears out.
Pretty much. They recognize that your assets lose value over time as you use them, and you get to deduct that loss, that sort of usage cost, each year.
And what's the real bottom line impact here? Is this just an accounting entry, or does it actually put money back in your pocket?
Oh, it's profoundly real. It's not just bookkeeping. When you depreciate an asset, you're systematically reducing its basis over time.
Basis being its cost for tax purposes.
Basically, yes, it's tax cost.
Yeah.
And crucially, that reduction in basis translates directly into a deduction that lowers your taxable income.
Lower taxable income means a lower tax bill. Simple as that.
Simple as that. It puts real money back in your business.
Huh.
And here's something important. Even if you, for some reason, don't actively claim the depreciation deduction in a given year, the asset's basis must still be reduced by the amount you could have claimed.
Wow. Okay, so you can't just ignore it and hope it goes away. The basis reduces anyway.
Exactly. Which highlights just how fundamental it is in the tax system. Now, for federal income tax purposes, the go-to method for most assets, the standard system, is the Modified Accelerated Cost Recovery System, MCRS.
MCRS, we'll be hearing that a lot, I take it.
You will. It's the main framework for depreciation.
Now, when you talk about assets, you mentioned things wear out, but it's critical to distinguish between two main types, right? Because they're treated differently for depreciation. First up, real property.
Right. Real property is essentially land and anything that's permanently affixed to it. So buildings, obviously.
Like the structure itself.
The structure, yes. But also things like paving you install. Permanent structures like, say, fences or certain built-in utility systems. If it's bolted down, built into the ground, or, a permanent fixture, it's generally considered real property.
Okay, land and things stuck to it. And then there's personal property.
Personal property, on the other hand, is tangible. You can touch it, but it's movable. Think of it as everything that's not permanently affixed to the land.
So the stuff inside the building, mostly.
Often, yes. Your machinery, your equipment, the computers you use, copiers, furniture, even company automobiles or light trucks. They're physical items, but you could theoretically pick them up and move them somewhere else. They aren't part of the real estate itself.
Okay, this seems like a crucial point, and you mentioned it's a common mistake, especially for new business owners or property investors. Land itself is not depreciable. You cannot write off the cost of the land.
That's a huge distinction, absolutely key. You cannot depreciate land. When you buy a property, say a building on a plot of land, You have to allocate the purchase price between the land and the building.
Because only the building part can be depreciated.
Exactly. The cost of the land must always be removed from the total cost when you're calculating depreciation for the building or any other depreciable improvements on that land. The logic is, well, land doesn't really wear out or become obsolete in the same way a building or machine does.
It just is.
It just is. So you depreciate the improvements on the land, not the land itself.
Okay, so that covers depreciation, that annual allowance for tangible assets, the stuff you can touch, that wears out. But what about assets you can't touch, like intellectual property, patents, or maybe the value of a brand's reputation you acquire when you buy another company? That brings us to amortization, right?
Amortization, exactly. It's essentially the parallel concept to depreciation, but it applies to intangible assets.
Intangible meaning not physical.
Not physical, correct. It's how you recover the costs for things like patents, copyrights, trademarks, licenses, franchises, or even the goodwill that's recorded when you purchase another business for more than the fair value of its identifiable assets.
So instead of recognizing wear and tear, you're recognizing what? The fading value.
Sort of, yes. You're recognizing the systematic reduction in the value or the finite useful life of these non-physical assets over time. You're spreading their cost over the period they're expected to provide economic benefit.
And how is amortization typically handled for tax purposes? Is it accelerated like MACRS auction is?
Generally, no. For tax purposes, amortization is usually done using the straight line method, nice and even over the recovery period.
Straight line. Okay.
And similar to how we treat some tangible assets under specific conventions, it typically employs what's called a full month convention.
Full month, meaning?
Meaning you get a full month of amortization in both the month the asset is acquired and the month it's disposed of, regardless of the specific day in the month.
Ah, okay. Simpler than trying to prorate by day.
Much simpler. And for many of these common intangible assets, particularly those acquired as part of buying a business, what they're called Section 197 intangibles, the most common recovery period for tax purposes is 180 months.
180 months, that works out to 15 years.
Exactly. 15 years, straight line, full month convention. That's the standard for a lot of acquired intangibles like goodwill or trademarks.
Now, just a quick note here, because sometimes these terms, depreciation, amortization, they get used in financial statements too, and the rules might not be identical, right?
That's a really good point to clarify. It's worth mentioning that there can be differences between the tax rules we're focusing on today and generally accepted accounting principles, or GAAP, which govern your financial statements.
So,
Well, for tax, we're often sticking to that 180-month straight-line rule for many acquired intangibles. For GAAP, however, the treatment can be more complex. Some intangibles might be subject to annual impairment tests instead of regular amortization, especially those deemed to have indefinite lives, like certain trademarks or goodwill under some circumstances. Others with finite lives are amortized for GAAP, but the period might differ from the tax period.
okay, so different rules for different purposes, but for this deep dive, focus purely on maximizing tax savings.
Our primary concern is that 180-month, or sometimes shorter, like for patents, straight-line rule set by the IRS for tax deductions. We're laser-focused on what reduces your tax bill today.
Fantastic clarification. So now that we've laid the groundwork, appreciation for tangible, amortization for intangible, let's really dive deep into MCRS, specifically for personal property. This seems like where a lot of businesses will find ongoing savings, right, on their everyday assets.
Absolutely. This is where your computers, your equipment, your vehicles start actively saving you real money on your taxes year after year. The first step in understanding MCRS for personal property is decoding its various classes.
Classes, like categories.
Exactly. The tax code categorizes personal property into different classes based on expected useful life, and this categorization determines the asset's tax life or recovery period. That period dictates how quickly you can deduct its cost.
Okay, so tell us about those categories. What are the main ones?
Certainly. MCRS assigns personal property to specific recovery periods. There's a 3-year class, but it includes very specific items, like some special manufacturing tools or, interestingly, racehorses over 2 years old. Not common for most businesses.
Right. Probably not claiming racehorses too often.
Probably not.
Mm-hmm.
Then you have the incredibly common 5-year class. This covers things almost every business uses. Automobiles, light trucks, computers, peripheral equipment like printers and copiers.
Okay, so all the essential tech in your office, plus company cars and small trucks, they generally fall into that 5-year bucket. That's huge.
It is. It means faster write-offs for those key assets. Next up is the 7-year class. This is another very common one. It's where you'll find most office furniture, desks, chairs, fixtures, as well as general machinery and equipment that doesn't fit elsewhere.
So the stuff that makes the office run, basically. Furniture, machinery.
Pretty much. Beyond those two big ones, there's a 10-year class for things like vessels, tugs, barges, water transportation equipment, mainly.
Less common again.
Less common for most. Then a 15-year class, which is interesting because it includes qualified improvement property to the interior of non-residential buildings. We'll touch on that more later. And also certain improvements made directly to land, like sidewalks, roads, landscaping, fences.
Ah, so some land improvements can be depreciated, just not the land itself.
Correct. Over 15 years usually. And finally, there's a 20-year class for very specific things like initial clearing and grading of land, certain farm buildings, and municipal sewers.
Okay, it sounds like a lot of categories, but I'm guessing, like you said, most businesses day to day are really going to be dealing with just a couple of these primarily.
You're absolutely spot on. The vast majority of personal property assets that a typical business will acquire, computers, furniture, equipment, vehicles, they fall squarely into either the 5-year or the 7-year classes.
So focus on 5 and 7-year property. That simplifies things a bit.
It really does. Whether you're a small startup buying your first computers or a large corporation outfitting an entire office, these two classes are going to be your primary focus for personal property depreciation under MAKRS.
And a simplifying rule that we touched on, but it's worth repeating because it's such a huge benefit compared to older depreciation systems. Under NQRS, salvage value is completely ignored, right?
That's a really big deal, yes. It streamlines the calculation significantly. Under older rules, you had to estimate what an asset might be worth at the end of its useful life, its salvage value, and subtract that before calculating depreciation.
Which sounds like a headache. And guesswork.
It was often both.
Oh.
NQRS does away with that entirely. You depreciate the full cost basis of the asset, which removes that layer of complexity and potential guesswork, and it often leads to larger deductions, especially upfront.
Okay, simpler and potentially bigger deductions. Now let's talk about how these deductions are often accelerated under MQRS. This is where you get larger deductions in the earlier years of an asset's life, which sounds fantastic for cash flow.
Right. Acceleration is a key feature of MACRS for most personal property. Specifically for the 3, 5, 7, and 10-year classes, those common ones we discussed, the depreciation is computed using the 200% declining balance method.
200% declining balance. What does that mean in plain English?
It essentially means the depreciation rate in the early years is double what the straight line rate would be. So you get much larger deductions up front, and they gradually decrease over the asset's recovery period. It front-loads the tax benefit.
So you recover your cost faster, tax-wise.
Exactly. For the slightly longer-lived 15 and 20-year personal property classes, it's a 150% declining balance method. Still accelerated compared to straight line, but a bit slower than the 200% method used for the shorter-lived assets.
Okay, so acceleration is built in. Now, the default rule, the convention that applies to most personal property most of the time, and one you absolutely need to know, is the half-year convention. How does this actually work in practice?
Okay, the half-year convention is the general rule. Under this convention, any personal property you place in service or dispose of during a taxable year is generally treated for depreciation purposes as if it happened exactly halfway through that year.
Regardless of the actual date you bought it or sold it.
Regardless of the actual date. So this means you typically get 6 months worth of depreciation in the very first year you acquire the asset, and also 6 months worth in the year you dispose of it, assuming you dispose of it before the end of its full recovery period.
Wait, so if I buy a big piece of equipment, say, on January 1st, I only get 6 months of depreciation for that first year.
Correct. Under the half-year convention, yes.
But if I buy that same piece of equipment on December 31st, I still get 6 months of depreciation for that year.
That's precisely how it works under the half-year convention.
That sounds, well, almost too good to be true if you buy late in the year.
It's designed for administrative simplicity. It avoids having to prorate depreciation based on the exact number of days you own the asset in the first and last years. The MSOKRS depreciation tables, the percentages you look up, actually have this half-year convention built right into the first-year rates.
Ah, so the table does the work for you in year one.
It does for year one. However, it's crucial to remember, if you dispose of the property before its full recovery period is up, you need to manually apply that half-year adjustment to the full-year MSIRS rate in the year of disposition. You only get half a year's worth of the tabulated depreciation in that final year.
Okay, let's walk through a concrete example to see the real impact. Let's use Acme Co. again. Say they purchased office furniture desks, chairs for $10,000. That's 7-year property. They bought it on February 14th of year 1. Then business changes, and they dispose of it on March 20th of year 3. How would the depreciation play out under MESI-RS with the half-year convention?
Okay, good example. So $10,000 basis, 7-year property, half-year convention applies. For year 1, we look up the MCRS rate for 7-year property, year 1. That rate is 14.29%, and it already includes the half-year convention built in. So year 1 depreciation is $10,000 times 14.29%, which equals 1,429%.
$1,429 deduction in year 1 just for buying furniture.
Correct. Now, for year 2, they own it the entire year. We use the year 2 rate for 7-year property, which is 24.49%. So $10,000 times 24.49% equals 2,449%. A bigger deduction in the second year due to the acceleration.
Okay, makes sense. Now, year 3, they sell it in March.
Right. So in year 3, they disposed of it before the end of its 7-year life. We find the full year rate for year 3, which is 17.49%, but because they disposed of it during the year, we have to apply the half-year convention. So we take half of that annual amount, $10,000 times 17.49% divided by 2. That gives us $874.50 for year 3.
So over those 3 years, they got $4,429 plus $2,449 plus $874 plus 50 cents, about $4,750 in deductions just from that initial $10,000 purchase.
Exactly. This really illustrates how buying something as simple and necessary as office furniture immediately starts putting money back in your pocket, or at least reducing your tax liability through these annual deductions.
Now, here's where it gets potentially strategic. You mentioned acceleration as the default. But is there ever a scenario where a business owner might choose not to take those bigger deductions up front? Can they opt for a slower method?
Absolutely. This is a key planning point. A taxpayer has the option to elect to use straight-line depreciation instead of the accelerated MACRS method.
They can just choose.
They can choose, yes. It's an election made year by year, class by class. When you make this election, you can choose to depreciate the property straight line over the regular MCRS recovery period, like 7 years for that furniture. Or you can elect to use an even longer recovery period defined under the alternative depreciation system, or ADS.
ADS, Alternative Depreciation System. So that stretches the deductions out even further.
Generally, yes. ADS periods are often longer than the standard MACRS periods. For example, that 7-year MACRS furniture might have a 10-year ADS life. And ADS always requires straight line.
So let's revisit Acme Co. If they had chosen to elect straight-line depreciation using the longer 10-year ADS recovery period for that $10,000 office furniture, how would that first year's deduction look compared to the accelerated MICRS we just calculated?
Big difference. With a 10-year straight-line life, the annual depreciation rate is 10%. $10,000 10 years equals $1,000 per year. But the half-year convention still applies in the year of acquisition, even under straight-line ADS. So for year 1, their depreciation would be $1,000 times 1/2, which is only $500.
Only $500 in year 1 compared to the roughly $4,429 they got under the accelerated MACRS method. That's a significantly smaller immediate deduction.
Significantly smaller.
So why on earth would anyone choose the slower method? It seems counterintuitive if the goal is maximizing tax savings now.
That's a crucial tax planning question. And it's not always about the biggest deduction this year. While accelerated depreciation is often appealing for immediate cash flow benefits, electing straight line, especially over a longer ADS period, might be a better strategic choice in certain situations.
Like when?
Well, imagine your business is currently in a loss position. You don't have taxable income to offset with deductions anyway. Taking a large accelerated deduction might not provide any immediate tax benefit and could even affect things like loss carryforwards.
Ah, so the deduction is wasted, in a sense, if you have no income.
Potentially, yes. Or perhaps you anticipate being in a much higher tax bracket in future years. By electing straight line now, you preserve larger deductions for those future higher income, higher tax years when they might save you more money overall.
So it's about smoothing things out, matching deductions to income over the long haul.
Exactly. It provides flexibility to manage your taxable income profile over time, rather than front-loading everything into the early years when it might be less valuable. It's a strategic decision based on your specific financial situation and projections.
That makes a lot of sense. It's not just about the method, but the timing and your overall tax picture. Okay, so the half-year convention is the default, offering that 6-month rule. But sometimes the rules shift dramatically. There's this thing called the mid-quarter convention. This sounds like a big one to watch out for. Maybe a trap?
It can definitely feel like a trap if you're not aware of it, but it can also be a planning opportunity. The mid-quarter convention is triggered by what tax pros often call the over 40% rule.
The 40% rule. What does that mean?
It means if more than 40% of the total cost basis of all depreciable personal property you place in service during a tax year is placed in service during the last 3 months of that year, the fourth quarter.
October, November, December.
Right. If more than 40% of your total purchases for the year happen in Q4, then the mid-quarter convention applies instead of the half-year convention. And critically, it applies to all personal property you place in service that entire year, not just the Q4 stuff.
Wow. So one big purchase late in the year can completely change the depreciation for everything else you bought earlier.
Precisely. It can fundamentally rewrite your depreciation calculations for the whole year. A single large equipment purchase in November, for example, could trigger this for everything.
And what's the impact on timing if that rule kicks in? How does mid-quarter work differently from half-year?
Under the mid-quarter convention, property is treated as placed in service or disposed of halfway through the quarter in which it was acquired or disposed.
Halfway through the quarter, not the year.
Correct. So property bought in Q1 January is treated as bought mid-February. Q2, April-June, is treated as mid-May. Q3, Jilsep, is mid-August. And Q4 as mid-November.
So you get more depreciation in the first year for stuff bought early in the year, but less for stuff bought late in the year compared to the half-year convention.
Generally, yes, that's the effect. Q1 purchases get 10.5 months of depreciation via the tables, while Q4 purchases only get 1.5 months in that first year. This requires using specific mid-quarter MACRS depreciation tables. There are separate tables with different rates depending on which quarter the asset was acquired.
Okay, sounds more complicated.
It is a bit more complex. And similarly, for dispositions under mid-quarter, there are specific timing rules based on the quarter of disposal. For example, if you dispose of an asset in Q1, you only get 1.5 months worth of that year's depreciation. Dispose in Q4, you get 10.5 months worth.
Let's walk through a more complex, real-world example to really see this in action. Sticking with Acme Co., let's modify the scenario. In year one, they still buy that $10,000 office furniture, 7-year property, on February 14th, which is Q1. But they also make a big computer purchase later in the year. $8,500 worth of computers, 5-year property, on October 30th, which is Q4. They still dispose of the furniture only on March 20th of year 3, Q1. How do we even begin to calculate depreciation here?
Okay, this is where careful calculation is key. The very first step before calculating any depreciation is the 40% test. We need to see if mid-quarter is triggered.
Right, so Q4 purchases divided by total purchases.
Exactly. The cost of personal property acquired in the fourth quarter is the $8,500 for computers. The total cost of personal property acquired during the entire year is $10,000 for the furniture, Q1, plus $8,500 for the computers, Q4, which totals $18,500.
So $8,500 divided by $18,500. Let's see, that's about 0.459 or 45.9%.
Correct. And since 45.9% is greater than 40%.
Bingo. The mid-quarter convention applies. And it applies to both the furniture bought in Q1 and the computers bought in Q4.
Precisely. This fundamentally changes the depreciation amounts for both assets compared to our earlier half-year example. We now have to use the mid-quarter tables.
Okay, so let's look at the impact on the first year's deductions using those tables. First, the computers, they were 5-year property bought in October Q4.
For the computers in year one, we use the specific 5-year MCRS table, but look at the column for property placed in service in the fourth quarter. The year one rate in that column is only 5%.
Only 5%. Wow. So $8,500 times 5% is just $425 per hour.
Just $425 in year one for the computers, because they were bought late in the year and mid-quarter applies. Compare that to the 20% rate under the half-year convention for 5-year property, it would have been $1,700. Big difference due to timing.
Okay, what about year 2 and 3 for the computers, still using the Q4 column?
For year 2, the rate from the 5-year Q4 column is 38%. So $8,500 times 38% is $3,230. And for year 3, the rate is 22.8%, giving $1,938%.
So the later years catch up a bit. Now, what about the office furniture? That was 7-year property, but acquired way back in February, the first quarter. How does mid-quarter affect that?
For the furniture in year 1, we use the 7-year MCRS table, but look at the column for property placed in service in the first quarter. The year 1 rate there is 25%. Much higher than the standard half-year rate of 14.29%.
Ah, so the early purchase gets a boost in year 1 under mid-quarter. $10,000 times 25% is $2,500.
Correct. A much larger first-year deduction for the furniture because it was bought early and mid-quarter was triggered. Now, for year two, the rate from the 7-year Q1 column is 21.43%. So $10,000 times 21.43% is 2,143%.
Okay. And then in year three, they disposed of the furniture in March, which is Q1.
Right. So for year three, we find the annual rate from the 7-year Q1 column, which is 15.31%. But since it was disposed of in the first quarter, we have to apply the mid-quarter disposition rule for Q1. This means we only get 1.5 months out of 12, or 12.5%, of the full year's depreciation. So it's $10,000 times 15.31% times 12.5%. That comes out to a very small $191.
Only $191 in the year of disposal because it was sold early in the year under mid-quarter. Wow. This truly shows how the timing of your purchases, especially large ones late in the year, can significantly alter your immediate tax deductions across the board.
It's a dramatic illustration. That big computer purchase in October forced Acme into the mid-quarter convention, leading to very different write-off amounts than they might have expected if they'd assumed the simple half-year rule. The furniture got more upfront, the computers got much less.
That's a critical strategic insight for business planning, especially around year-end. You need to be aware of that 40% threshold.
It's a classic example of how a seemingly small detail in purchase timing can have a large financial consequence. It really underscores the importance of, well, maybe talking to a tax professional before making significant asset acquisitions late in the year.
Absolutely. Okay, so far we've focused heavily on personal property, the computers, furniture, equipment. But what about the really big investments like buildings? We need to talk about navigating depreciation specifically for real property.
Right. Buildings and other real property have their own distinct set of depreciation rules under Mass ERS. They aren't lumped in with the 5 or 7-year stuff.
First things first, does that no salvage value rule still apply?
Yes, thankfully. Just like with personal property under Mass ERS, salvage value is also ignored when computing depreciation on real property. You depreciate the full allocated cost basis of the building or improvement.
Okay, that consistency is helpful. So what are the key differences in the rules for structures compared to personal property? Are the lives longer?
Much longer, generally. And it's always straight-line depreciation for real property under Manx ERS, no acceleration methods like declining balance.
Straight line only. Got it.
And for real property, we differentiate between two main types for determining the recovery period. First, there's residential rental property.
Like apartment buildings
Yeah.
or a house you rent out.
Exactly. Apartment buildings, rental homes, duplexes where you rent out units. If 80% or more of the gross rental income comes from dwelling units, it's generally residential rental. This type of property is depreciated straight line over 27.5 years.
27.5 years. Okay. What about other types of buildings? Offices, warehouses, stores?
That falls under the category of non-residential real property. This includes office buildings, warehouses, factories, retail stores, any commercial space that isn't primarily residential rental. Non-residential real property is depreciated straight line over a significantly longer period, 39 years.
39 years. Wow, that's a long time to recover the cost.
It is. Tax rules significantly lengthen the recovery periods for real estate compared to older systems.
And it's worth hammering home that critical reminder again for anyone involved in buying or owning real estate.
Yes, absolutely. Despite being real property, remember, the land component is never depreciable. You must allocate the purchase price between the depreciable building, or improvements, and the non-depreciable land. Only the cost allocated to the structure gets depreciated over 27.5 or 39 years.
That allocation is key. Don't try to depreciate the whole purchase price.
Definitely not. The IRS pays close attention to land allocation.
Now, for real property, there's another unique timing convention we need to know, different from half-year or mid-quarter. It's the mid-month convention.
Correct. Real property placed in service or disposed of uses the mid-month convention.
Mid-month, how does that work?
Under the mid-month convention, the straight-line depreciation is calculated based on the number of months the property was actually in service during the tax year. But the key here is that the property is treated as being placed in service or disposed of exactly halfway through the month, regardless of the actual day.
Halfway through the month.
Yes. So if you acquire a building on April 6th, for tax appreciation purposes, it's treated as placed in service on April 15th. If you sell it on March 20th, it's treated as disposed of on March 15th. This means you get half a month's depreciation in the month of acquisition and half a month in the month of disposition.
So in the first year, you count the number of full months you owned it, plus half of the month you bought it.
Exactly. And in the year of sale, you count the number of full months before the sale month plus half of the month you sold it.
Let's illustrate with our Acme Co. example again. Suppose they buy an office building that's 39-year non-residential property for $100,000. Let's assume that's the cost allocated just to the building, not the land. They purchase it on April 6th of year 1. Later, they dispose of it on March 20th of year 3. How do we calculate the depreciation using mid-month?
Okay, $100,000 basis, 39-year non-residential mid-month convention. First, the annual straight-line depreciation rate for a 39-year property is 1 divided by 39, which is about 2.564% per year.
Okay, 2.564% annually.
For year 1, they purchased it in April. So applying mid-month, they get depreciation for half of April, plus May, June, July, August, September, October, November, December. That's 8.5 months.
8.5 months out of 12.
Right. So the year 1 depreciation is $100,000 times the annual rate of 2.564%, multiplied by 8.512. That calculation comes out to approximately 1,864%.
$1,816 in year 1. What about year 2?
Year 2 is easy. They owned it for the entire year. So it's simply the full annual depreciation. $100,000 times 2.564%, which equals 2,564%.
Straightforward. And year 3, they sold it on March 20th.
So applying the mid-month convention to the disposition, they get depreciation for January, February, and half of March. That's 2.5 months.
2.5 months out of 12.
Correct. So the year 3 depreciation is $100,000 times 2.564% multiplied by 2.512. That gives us approximately $534.
Okay. So for anyone in real estate, whether owning rental properties or operating from owned commercial buildings, understanding that mid-month convention is really crucial for getting the depreciation right from day 1.
Absolutely. Or at least from month 1.5. These seemingly small convention rules, half-year, mid-quarter, mid-month, they really add up over time and significantly impact your bottom line, especially with large investments like real estate. Getting them right is fundamental.
No kidding. Okay, now we're moving into what I earlier called the big guns of tax savings. We've built the foundation with MCRS depreciation, but now let's talk about Section 179 and bonus depreciation. These provisions can truly turbocharge your deductions, right? This is where businesses can see a really dramatic, immediate impact on their tax liability.
This is definitely where things get very exciting for business owners looking for significant tax breaks now. Let's start with Section 179. It's an incredibly powerful election that allows a taxpayer to immediately expense, meaning deduct the full cost up front, a certain amount of the cost of qualified business use property in the very year it's purchased and placed in service.
Instead of depreciating it over 5, 7, or even 39 years.
Exactly. Rather than spreading the deduction out over years via MCRS, Section 179 lets you take a huge chunk, potentially the entire cost for smaller purchases, all in year 1. This is how you can see truly massive, immediate tax savings. It's like pressing a fast-forward button on your deductions.
That sounds like a massive game changer for cash flow. What exactly qualifies for this immediate expensing? And maybe just as importantly, what absolutely does not qualify? We need to be crystal clear here to avoid mistakes.
Absolutely critical to know the boundaries. Eligible property for Section 179 primarily includes tangible personal property, the kind we discussed earlier that typically falls under MCRS. Things machinery, equipment, computers, software off the shelf, office furniture, vehicles used primarily for business.
So mostly the 5-year and 7-year stuff.
Generally, yes. But here's a very important expansion. Section 179 also extends to certain qualified real property improvements. This is a big one.
Real property? I thought that was usually 27.5 or 39 years.
Normally, yes, but Section 179 carves out an exception for specific types of improvements made to the interior of an existing non-residential building.
Existing non-residential. Okay, what kind of interior improvements?
Think roofs, heating, ventilation and air conditioning, HVAC systems, fire protection and alarm systems, and security systems. If you replace the roof on your existing office building, or install a new HVAC system, or upgrade security, those costs might be eligible for immediate Section 179 expensing, rather than being depreciated over 39 years. That's a huge acceleration.
That is huge. So if I upgrade my office building's security system, that could qualify under 179. But what if it's a brand new building I just constructed?
Good question. The Qualified Improvement Property Rule applies only to improvements made to existing non-residential buildings. It doesn't apply to improvements made as part of new construction.
Okay, existing only. And what about residential buildings? If I put a new roof on my apartment building?
No, unfortunately not for Section 179. The building must be non-residential. Improvements to residential rental property don't qualify for Section 179 expensing under this rule.
Got it. Existing non-residential specific interior improvements like roofs, HVAC, security, fire systems. What else is completely ineligible for Section 179? What should people definitely avoid trying to expense this way?
It's vital to know the exclusions to avoid costly mistakes. First, intangible assets are out. Things like goodwill, patents, copyrights don't qualify for 179.
Okay, no intangibles.
Land itself is out, obviously, and also land improvements, things like parking lots, sidewalks, landscaping, swimming pools. Those are generally ineligible for Section 179.
Even though some land improvements get 15-year MACRS.
Correct. They might be depreciable over 15 years under regular MCRS, but they don't qualify for the immediate expensing under Section 179. Also, elevators or escalators, even if they're installed inside an existing non-residential building, are specifically excluded by the law.
No elevators. Weird, but okay.
It's just one of those specific carve-outs. Any real property that isn't that specific qualified real property we just discussed. So the building structure itself or any residential rental property won't qualify. And finally, a few other key exclusions. Tangible personal property that's used less than 50% for business doesn't qualify. Property acquired by gift or inheritance is out. It has to be purchased. And property acquired from a related party, like a family member or a controlled corporation, is also generally ineligible.
That's a lot of important detail on eligibility. Now, what about the limits? There must be a cap on how much you can immediately expense each year, right? It can't be unlimited.
You're right, there are definitely limits, the fine print you need to know to maximize the benefit. For 2023, the maximum amount of Section 179 expense deduction a taxpayer could claim was quite substantial, $1,160,000. Note, these figures adjust annually for inflation, so always check the current year's limits.
Over $1 million in immediate expensing potential. That's significant.
It is. However, there's a catch. This maximum $1,160,000 allowance is reduced dollar for dollar by the amount of qualified property the taxpayer places in service during the year that exceeds a certain investment threshold. For 2023, that threshold was $2,890,000.
Okay, so if you buy too much qualifying property in a year, your Section 179 limit actually starts to shrink.
Exactly. If your total qualifying purchases for the year exceed $2.89 million for 2023, your $1.16 million expensing limit starts fading out. If you place in service, say, $3 million of property, that's $110,000 over the threshold, so your Section 179 limit would be reduced by $110,000. It's designed to target the benefit more towards small and medium-sized businesses, not extremely large capital investors.
That makes sense. Is there another crucial limit related to income? Because a deduction is only useful if you actually have income to offset, right?
Precisely. This is a big one. The Section 179 deduction you claim in a year cannot exceed your business's aggregate taxable income before the Section 179 deduction itself. This calculation is usually done at the entity or individual level, depending on the business structure.
So Section 179 can't create or increase a net operating loss, NOL, for your business.
Correct. It can reduce your taxable income down to zero, but it can't push you into a loss position for tax purposes. If the calculated Section 179 deduction is more than your business taxable income limit, the excess amount isn't lost forever, though.
Oh, what happens to it?
Any amount that can't be deducted in the current year due to this taxable income limitation can generally be carried forward and definitely be deducted in future years, subject to the taxable income limit in those years. So it provides some flexibility, but you don't get the immediate benefit if you don't have the income.
Okay, carry forward is helpful. Let's do a quick comparison just to see the raw power here against standard depreciation. Suppose Nicholas Inc. places $50,000 worth of 5-year property, maybe some new equipment in service during the year. How does selecting Section 179 compare to just taking the standard MACRS deduction?
Okay, $50,000 of 5-year property. Under standard MCRS, using the half-year convention, the year-one depreciation rate for 5-year property is 20%. So Nicholas Inc. would get a depreciation deduction of $50,000 times 20%, which is $10,000 in year one.
$10,000 deduction via regular depreciation.
Right. However, if Nicholas Inc. elects Section 179 for that $50,000 purchase, and assuming they are well below the overall investment limit and have sufficient business taxable income,
They can deduct the entire $50,000 immediately in year one?
Yes, a full $50,000 deduction in year one compared to only $10,000 under regular MCRS.
Wow. So Section 179 provides a five-fold larger deduction in the very first year in that scenario. That's a huge difference for their tax bill and cash flow.
It's a massive difference, offering immediate and substantial cash flow benefits by drastically reducing current year taxes.
But what about that when not to scenario you hinted at earlier with the straight line election? Does that apply here too? Why wouldn't you always take the biggest deduction possible with Section 179?
It's the same logic. While electing Section 179 often yields the greatest immediate deduction, which is frequently what businesses prioritize for cash flow, there are strategic reasons why you might not. Again, if the business is in a loss position, that big 179 deduction might not provide a current tax benefit due to the taxable income limitation.
So you might carry it forward, but you lose the immediate impact.
Exactly. Or, similar to the straight line scenario, if you anticipate being in a significantly higher tax bracket in the near future, maybe taking the standard MCRS deduction spread over several years will ultimately save more tax dollars than taking the entire deduction now in a lower tax year. It requires forecasting and strategic thinking about your tax rates over time.
So again, it's about optimizing the deduction against your income and tax rates, not just blindly taking the biggest number this year.
Precisely. Maximum immediate deduction isn't always the optimal long-term strategy.
Okay, this is where practical understanding truly shines. Let's look at that scenario with Mary, the CPA, reviewing her client Kay Jones's tax data. Kay has a consulting business and also owns some rental property. Mary's tax software automatically applied Section 179 to several new assets Kay purchased, but Mary needs to double-check if they actually qualify. This sounds like a common real-world situation.
Very common. Software can make suggestions, but the human expert needs to verify eligibility based on the specific facts.
Okay, let's try to diagnose these flagged assets based on what we've learned. First up, asset 225 on the list, an apartment building security system. Kay installed a new system in her residential rental property. Software flagged it for 179. Eligible.
My immediate reaction is no. Mary should definitely remove that Section 179 election. As we discussed, qualified real property improvements for Section 179 must be for non-residential buildings. The security system installed in an existing residential apartment building is explicitly not eligible. That's a frequent point of confusion.
Okay, clear diagnosis. Ineligible. Next, asset 230. An office building security system. Kay also upgraded the security in the building where she runs her consulting business. Software flagged this too. Eligible.
This one sounds eligible. Assuming the office building is non-residential and existed before the improvement, a security system installed in the interior is one of the specified types of qualified improvements. So yes, Mary should definitely keep the Section 179 election here, assuming Kay meets the other limits.
Good. Okay. Asset 236. An office building elevator. Kay replaced an old elevator in her non-residential office building. Eligible. It's an improvement in a non-residential building.
True, it meets those criteria, but unfortunately, elevators and escalators are one of those specific items explicitly excluded from the definition of Section 179 qualified improvement property.
Ah, that specific exclusion we mentioned.
Exactly. So even though it feels like a major building system improvement, it's specifically carved out by the law. Mary should remove the Section 179 election for the elevator. It has to be depreciated normally, likely over 39 years.
Okay, ineligible due to specific exclusion. Finally, asset 242. An office building parking lot. Kay repaved and expanded the parking lot for her office building. Eligible.
No, absolutely not eligible for Section 179. Remember, land improvements like parking lots, paving, landscaping are explicitly not eligible for Section 179 immediate expensing.
Right, even though they might be depreciable over 15 years under MCRS.
Correct. The cost of the parking lot is a land improvement and cannot be expensed under Section 179. Mary definitely needs to remove that Section 179 code from Asset 242.
Wow. This diagnostic exercise really clarifies things. It shows how absolutely critical it is to know not just the general rules, but the precise definitions and exclusions for Section 179. A simple misunderstanding between residential and non-residential, or forgetting about excluded items like elevators or land improvements.
It could mean missing out on a significant deduction you were entitled to, or worse, incorrectly claiming one and facing potential penalties and interest from the IRS down the road. It's not just about knowing the rule exists, but knowing exactly how and when it applies.
It really highlights the need for careful review, maybe professional advice, especially when dealing with real property improvements or less common assets. Those details matter immensely.
They absolutely do. Even small definitional details can have very large financial implications when you're talking about Section 179 limits.
Okay, so Section 179 is a powerful tool for immediate expensing. But beyond that, there's another big gun in the tax-saving arsenal, often used right alongside it: bonus depreciation. What is this, and how does it fit into the picture?
Bonus depreciation is another incredibly powerful tool, sometimes called additional first-year depreciation. It allows a taxpayer to expense an additional percentage of the cost of qualified property placed in service in the current year, right off the top.
An additional percentage on top of regular depreciation, or Section 179.
It works in conjunction with them. It essentially gives you another layer of immediate deduction, often applied after Section 179, but before regular MCRS depreciation kicks in.
Okay, another way to accelerate deductions. What kind of property qualifies for bonus depreciation? Is it the same stuff as Section 179?
There's a lot of overlap, but some key differences. Generally, qualified property for bonus depreciation is tangible personal property with a MCRS recovery period of 20 years or less. So that covers your typical 5-year and 7-year assets, and even the 15-year land improvements and 20-year farm buildings.
So a broader category potentially than Section 179's focus.
In some ways, yes. Importantly, bonus depreciation also generally applies to qualified improvement property, QIP. Those interior improvements to non-residential buildings we discussed for 179, even though QIP technically has a longer MCRS life, if not expensed under 179. Bonus often picks it up.
That's good to know. Are there other stipulations for bonus?
Yes, a couple of key ones. First, the property generally must be new to the taxpayer, meaning its original use begins with you. You typically can't claim bonus on used property you acquire, although there have been some exceptions at times. Section 179, importantly, can be claimed on used property.
Ah, big difference. Section 179 for used, bonus generally for new.
That's a major distinction. Also, similar to Section 179, property acquired from a related party generally doesn't qualify for bonus depreciation.
Okay, new property, 20 years or less life, or QIP, not from a related party. Now, this sounds extremely impactful, especially if the percentage is high. But I've heard that the bonus depreciation percentage has been changing quite dramatically recently. This seems absolutely critical for tax planning, doesn't it? Because it directly affects when you might want to make a major purchase.
Absolutely vital. Understanding the current and upcoming bonus depreciation rates is essential for making timely purchasing decisions to maximize this benefit. Congress set it up with a phasing down schedule.
What did that look like?
Well, it was incredibly generous for a while. For qualified property placed in service from late 2017 through the end of 2022, the bonus depreciation rate was 100%.
And a percent. So you could write off the entire cost of new qualifying assets immediately on top of Section 179.
Essentially, yes, subject to some ordering rules we'll get to. It was a massive incentive. However, that 100% rate began phasing down. For property placed in service during 2023, the rate dropped to 80%.
Still very high.
Still very high. For property placed in service during 2024, it dropped again to 60%.
Okay, so for this year, 2025, where does that leave us?
For property placed in service in 2025, the bonus depreciation rate is scheduled to be 40%.
40%. Still significant, a major boost, but clearly less than the 180 or 60% we saw in prior years.
Correct. And looking ahead, the planned phase down continues. It's set to drop to 20% for property placed in service in 2026.
And
then, under current law, it's scheduled to phase out completely, drop to 0% starting in 2027, unless Congress steps in and changes the law again, which they sometimes do.
wow. So this phase down is incredibly important information. Knowing the rate is only 40% for 2025 and potentially dropping further really creates an incentive if you're considering a significant acquisition of new qualifying assets.
You need to factor this into your timing. That remaining 40% bonus depreciation this year, or even the 60% last year, could be a powerful reason to accelerate purchases to capture that larger immediate deduction before the benefit diminishes further or disappears entirely. It requires proactive planning.
Definitely. Is there any special rule for vehicles under bonus depreciation, given they're such common business assets?
Yes, there is a little kicker for vehicles. In addition to the regular MACRS limits and the bonus percentage, there's typically an additional $8,000 first-year depreciation amount allowed specifically for new passenger automobiles, light trucks, and vans on which bonus depreciation is claimed. It's an extra boost just for vehicles.
An $8,000 bump. Nice. Okay, now this is probably the most critical piece for implementation. the golden rule for maximizing your total cost recovery deductions. What is the required order of application when you're potentially using Section 179, bonus depreciation, and regular MCRS depreciation all on the same assets in the same year? Because you said it's not a free-for-all. There's a sequence.
You're absolutely right. There's a strict hierarchy, and following it is absolutely critical for calculating your maximum allowable deduction accurately. You must apply these provisions in this specific order. Okay, number one. Number one, the Section 179 expense deduction is claimed first. You apply it to your eligible property purchases up to the Section 179 limit and the business taxable income limit.
Section 179 first. Got it. Number two.
Number two, bonus depreciation is claimed next. But, and this is key, bonus depreciation applies only to the remaining basis of the asset after any Section 179 deduction has been applied to it. So if Section 179 expensed a portion of the cost, bonus applies to the leftover basis. You calculate the bonus percentage, like 40% for 2025, on that reduced amount.
Okay, bonus is second, applied to the post-Section 179 basis. And number three.
Finally, number three, regular MCRS depreciation is claimed last. This is calculated on any further remaining basis after both Section 179 and bonus depreciation have been subtracted from the original cost. You then apply the appropriate Year 1 MCRS percentage using the correct convention like half year or mid-quarter to that final remaining basis.
So it's a three-step waterfall. Section 179 takes the first bite, bonus takes the second bite from what's left, and regular MCRS gets the crumbs at the end.
That's a great way to visualize it. It's a mandatory sequence for maximizing your total cost recovery deduction in that first year.
Let's put all of this together now with an ultimate tax-saving strategy example. Let's use Company A. Suppose in 2023, when bonus was 80%, Company A placed $3 million worth of new 7-year MCRS property, maybe heavy machinery in service. They want to elect the maximum Section 179 possible and take the maximum total cost recovery deduction allowed for that year. Walk us through the process, step by step, following that stacking order, and let's see what the final impact would be.
Okay, this is a fantastic comprehensive example that really shows the power of strategically combining these provisions. $3 million of new 7-year property in 2023.
Step 1, Section 179. How much can they take?
First, we check the investment limit phase-out for 2023. The threshold was $2,890,000. Company A placed $3 million in service, which is $110,000 over that threshold. $3 million, $2,890,000, $110,000.
So their $1,160,000 maximum allowance gets reduced.
Correct. It's reduced dollar for dollar by that $110,000 excess. So their maximum allowable Section 179 deduction for 2023 is $1,160,000 minus $110,000, which equals $1,050,000. That's their step 1 deduction, assuming they have enough business income.
Okay, $1.05 million expensed immediately via Section 179. Now, step 2, bonus depreciation, applied to what's left, right?
Exactly. We start with the original cost of $3 million and subtract the $1,050,000 already expensed under Section 179. That leaves a remaining basis of $1,950,000.
And the bonus rate for 2023 was 80%.
Correct. So we apply the 80% bonus rate to that remaining basis. $1,950,000 times 80% equals $1,560,000. That's their step 2 bonus depreciation deduction, another huge chunk.
Unbelievable. Okay, so after 179 and bonus, is there anything left for step 3, regular and CRS?
Let's see. Original cost was $3 million. We subtract the $1,050,000 from Section 179, and we subtract the $1,560,000 from bonus. That leaves a final remaining basis of only $390,000.
Only $390K left out of the initial $3 million.
Right. This remaining $390,000 is the amount that then goes into the regular MCRS depreciation calculation for year 1.
Yeah.
It's 7-year property, and assuming the half-year convention applies, let's assume they didn't trigger mid-quarter, the year 1 MSCRS rate is 14.29%.
So $390,000 times 14.29%.
Comes out to approximately $55,731. That's their step 3 regular MCRS depreciation deduction for year 1.
So the grand total cost recovery deduction for Company A in that single year from that $3 million purchase would be the sum of all 3 steps.
Exactly. We add them up. $1,050,000, Section 179, plus $1,560,000 bonus depreciation, plus $55,731 in MCRS, an absolutely astonishing $2,665,731 in total deductions for the year.
Over $2.6 million deducted in year one on a $3 million purchase. That is incredible. This example beautifully demonstrates how strategically combining these powerful provisions following that strict ordering rule can lead to colossal immediate deductions.
It dramatically slashes taxable income and effectively puts millions back into the business's cash flow right away
Uh-huh.
through tax savings. This is truly how savvy businesses and their advisors manage tax liability and cash flow, turning necessary asset purchases into significant tax advantages.
It's a testament to the power of understanding these tax provisions 179 bonus, MACRS, the conventions, the limits, the ordering, and applying them strategically to maximize your financial benefit. Just phenomenal potential savings.
Absolutely requires attention to detail, but the payoff can be enormous.
Okay, so we've thoroughly covered depreciation for both personal and real property, and then really unleashed the big guns of Section 179 and bonus depreciation for immediate expensing. Now, let's circle back to where we started briefly, amortization, and delve a bit deeper into the details of recovering costs for those intangible assets.
Right. We established the basics earlier. The general method for amortizing intangible assets for tax purposes is the straight line method.
Nice and steady.
Steady deduction each year. And it typically uses that full month convention we discussed,
Yeah.
meaning you get a full month's worth of amortization in both the month you acquire the intangible and the month you dispose of it.
And the most common recovery period, especially for things bought in a business acquisition.
Is generally 180 months, which is 15 years. That applies to a wide range of Section 197 intangibles.
Section 197. So that 15-year rule is pretty common. What about specific types of intangible assets? Do they all follow that neat 15-year rule, or are there variations we should know about?
Good question. While 15 years is very common for acquired intangibles under Section 197, there are some important nuances in other categories. First, let's confirm Section 197 intangibles. This includes goodwill purchased in a business acquisition, customer lists, workforce in place, licenses, permits, covenants not to compete, franchises, trademarks, trade names. All those are generally amortized straight line over 180 months from the month they were purchased.
Okay, 15 years for that bundle of acquired assets. What about capitalized research and experimental R&E costs? These seem critical for innovative companies. How are those handled now? There are recent changes here, weren't there?
Yes, this is a significant recent change. Starting in 2022, domestic R&E costs must be capitalized and amortized over 5 years, or 15 years for foreign R&E. You can no longer immediately expense them as incurred. This amortization begins from the midpoint of the year the expenses are paid or incurred.
So R&E costs are now spread over 5 years, or 15 for foreign, starting mid-year. That's a big shift from immediate expensing.
A very big shift, impacting cash flow for R&D intensive companies.
What about patents and copyrights specifically, if you buy one or create one?
If you purchase a patent or copyright separately, not as part of a Section 197 business acquisition, they are generally amortized straight line over the remaining legal life. If they are self-created, they are typically amortized over their full legal life from the point they are granted or registered. The goal is to match the cost recovery to the period of legal protection and economic benefit.
Makes sense. And loan costs, like the fees you pay up front to get a business loan.
Those costs incurred to obtain debt financing, often called debt issuance costs, must be capitalized and amortized straight line over the actual term or life of the loan itself. So if you pay fees to get a 10-year loan, you spread the deduction for those fees over that 10-year period.
Okay, matches the loan term. Now here's one that's particularly important for anyone starting a new business. Organizational costs and startup costs. These can be significant expenses in those crucial early days before you even open your doors.
This is a key area, and thankfully the tax rules here offer a very beneficial dual approach that can provide a nice boost right at the beginning.
A dual approach. How does that work?
For both organizational costs, like legal fees for incorporation, state filing fees, and startup costs, like market analysis, employee training before opening, advertising for the opening, new businesses can generally elect to immediately expense a portion of these costs in the year the business begins.
An immediate deduction right away. That's helpful for new ventures.
Very helpful. Businesses can elect to immediately deduct up to $5,000 of organizational costs A&D, up to $5,000 of startup costs in the year active trade or business begins. So potentially $10,000 in immediate deductions right off the bat.
Wow, $5,000 for each category. Is there a catch, like the Section 179 phase-out?
Yes, there's a similar phase-out rule. This $5,000 immediate expensing allowance for each category, organizational and startup, is reduced dollar for dollar by the amount that the costs in that specific category exceed $50,000.
Okay, so if your organizational costs were, say, $52,000, your immediate $5,000 deduction would be reduced.
Correct. Since $52,000 exceeds $50,000 by $2,000, your immediate expensing limit for organizational costs would drop from $5,000 down to $3,000. $5,000, $2,000. If your costs hit $55,000 or more in a category, the immediate expensing for that category disappears completely.
Got it. So you get up to 5K immediate, but it phases out if costs are high. What happens to the costs not immediately expensed, the amount over $5,000, or the whole amount if you phase out?
Any remaining costs in each category after subtracting the amount immediately expensed, if any, are then capitalized and amortized straight line over a period of 180 months, 15 years.
Ah, back to the 15-year amortization.
Yes, and crucially, this 180-month amortization period begins with the month in which the active trade or business actually begins operations.
Okay, let's apply this with a practical example. Say ABC Company was incorporated on June 30th, year one, and officially started business operations, say, opened its doors on July 1st, year one. They incurred $26,000 in qualifying organizational costs, legal fees, state fees, and $52,000 in qualifying startup costs, market research, pre-opening advertising. How would their total deduction for these initial costs look in year one?
Okay, let's break it down by category, following the rules. First, organizational costs. The total is $26,000.
Is that below the $50,000 threshold?
Yes, $26,000 is well below $50,000, so they can immediately expense the full $5,000 allowance for organizational costs in year one.
$5,000 immediate deduction. Good start. What's left?
They had $26,000 total, minus the $5,000 expense leaves $21,000 remaining. This $21,000 must be capitalized and amortized over 180 months.
Okay, $21,000 divided by 180 months.
Comes out to $116.67 per month. Since their active business began on July 1st, year one, they get amortization for July, August, September, October, November, December. That's 6 months in year one.
So $116.67 times 6 months.
Mhm.
Roughly $700.
It's exactly about $700,
Yeah.
$116.67. 6 equals $700.02. So for organizational costs in year one, their total deduction is the $5,000 immediately expensed plus the $700 amortized, totaling $5,700.
Okay, $5,700 for org costs.
Yeah.
Now let's look at the startup costs. They had $52,000 total. That is above the $50,000 threshold.
Correct. So the $5,000 immediate expensing allowance for startup costs is reduced. The costs, $52,000, exceed the threshold, $50,000 by $2,000.
So the $5,000 allowance is reduced by $2,000.
Yes. $5,000 minus $2,000 means only $3,000 of the startup costs can be immediately expensed in year one.
Okay, $3,000 immediate deduction for startup costs. What's left to amortize?
The total startup costs were $52,000. They expensed $3,000 immediately. So the remaining amount to be capitalized and amortized is about $272 minus 22 cents per month. Again, since the business started July 1st, they get 6 months of amortization in year one.
$272 divided by 102 cents times 6 months. About 1,633 lepers.
Right, approximately $1,633.
Yeah.
$272.22, 632 cents. So for startup costs in year one, their total deduction is the $3,000 immediately expensed plus the $1,633 amortized, totaling $4,633.
So bringing it all together, ABC Company's total deduction for both organizational and startup costs combined in their first year of operation, year one, is...
It's the sum of the two parts, $5,700 org costs plus $4,633 startup costs, $333.
over $10,000 in deductions just from those initial formation and launch expenses. For anyone launching a new venture, understanding and properly claiming these initial deductions for organizational and startup costs seems like it could be a really crucial boost to your early financial health and cash flow.
It absolutely is. It's an immediate way to reduce your taxable income right out of the gate, often when cash flow is tightest. It helps your new business breathe a little easier financially in that critical first year.
It's tangible savings, often overlooked by new entrepreneurs who are understandably focused on a million other things involved in getting a business off the ground. But this is free money, essentially, through tax savings.
It really is. Knowing these rules can make a genuine difference to a startup's bottom line.
Wow. We've covered a tremendous amount of ground today. We've journeyed through the intricate, yet as we've seen, incredibly rewarding world of cost recovery.
From the foundational principles of depreciation for tangible assets and amortization for intangibles.
Right, understanding MCRS, the different property classes, those crucial conventions like half-year, mid-quarter, and mid-month.
All the way to the really powerful immediate deductions offered by Section 179 expensing and bonus depreciation and how they stack together.
It's truly a vast landscape, but one filled with opportunities for significant tax savings if you know how to navigate it.
You now have a much clearer understanding, hopefully, of how the type of asset you own, when you acquire it, and the specific tax selections you make can profoundly impact your financial position.
Those aha moments we discussed, realizing the impact of the 40% rule from mid-quarter, knowing exactly what qualifies as eligible property for Section 179 versus what doesn't, understanding that crucial stacking order for deductions.
That's where the real practical tax savings are unlocked. Those details matter.
These aren't just obscure lines in the tax code. They are powerful financial levers. Levels for managing your business's cash flow, reducing your tax burden, and ultimately improving your overall financial health.
Understanding them empowers you, the business owner or investor, to make smarter purchasing decisions, plan more effectively around year-end, and optimize your tax strategy not just for 1 year, but potentially for many years to come. The savings can be substantial.
Tens, hundreds of thousands, even millions of dollars, as we saw in that Company A example.
Depending on the scale of your investments, absolutely.
So, as we wrap up this deep dive, maybe a final thought for you, our listener, to consider as you look at your own situation.
What hidden deductions might your business or perhaps your personal investments be missing out on right now, simply by not fully understanding how your assets recover their cost through these rules?
And digging a bit deeper, how might strategically timing your future purchases, especially considering those phasing bonus depreciation rates down to 40% this year, 20% next year, impact your tax position not just this year, but for the crucial years ahead?
It's a powerful thought, isn't it? Something to definitely mull over as you look at your balance sheet, plan your capital expenditures, and consider how those assets can become powerful tax-saving tools in your financial strategy.